Hello everyone, it's Professor Reiko here again, continuing on with our sixth video on investments, all right, and we're now in the equity investment portion of the chapter. All right, so the last video I provided a brief overview of the types of equity securities and the classifications of it. And so now what we're going to do is go through those categories together, starting with the fair value method, all right? So the Kiso book calls this the fair value method. The Spiceland book calls it fair value through net income, and that just means that the fair value, the unrealized gains and losses go through net income. So, but they mean the same thing and account for them pretty much the same. A small difference on the sale that I'll point out in just a minute. All right, so we've got a company. They purchased common stock of two separate companies. Notice here both less than a 20% interest, which means we have a passive interest, and we'll be using the fair value method. All right, so it gives the cost right here. So this is the cost when we purchased them on 10/13, and then the fair market value on 12/31. And then it goes on. So in the previous ones, I've added this column on right here and had to write it out here. I just went ahead and typed it in. All right, so if you look at this, this is the way I believe the Kiso book presents it a lot of time. I typically focus on the unrealized gain or loss portion of that journal entry, whereas the books, both Spiceland and Kiso, typically focus on the fair value adjustment. All right, and that's what this does down here. You can see the securities fair value adjustment amounts. All right, so the way to read this in terms of the T account, this is the ending balance of the T account. All right, so remember, the number that you calculate over here is always the ending balance. This is the beginning balance of the T account, which is 0 is the first year, and this is the adjusting journal entry number. All right, so when I write it out in T, I usually put a T account next to the problem, but here I should just show you a different way that it can be presented and to make sure you understand both of those ways and are able to handle that. All right, so they also received a cash dividend during the year. We don't care who it's from. It will still account for it the same. So we want the entries for the purchase, the dividend, and adjust the fair value at the end of the year. So let's do those now. All right, so I'm going to scroll down a little bit. All right, so our first journal entry is going to occur on 10/13, all right, of 17, when we actually purchased them, all right? So I'm going to call this equity investment, and I'm just going to put dash company 1, equity investment, dash company 2. Those are both debits, so that goes on for 363,500. and 273,400. Those numbers were both given up there in the table. And then that's a credit to cash because we're buying them, all right, for 636,900. Now the equity investment, it could be called investment in equity securities, investment in company 1 equity. Any of those combinations are fine. You'll just see it a little bit different in different books. All right, on the 15th, we received the dividend. All right, so when we receive dividend, that's us receiving it. All right, so we're going to debit cash for 7,000, and then we're going to record it as dividend revenue for 7,000. All right, at the end of the period, we need to adjust it to its market value. All right, so that's all this stuff over here. So we know that we're going to need to use these numbers. All right. So we already determined that it was, if you look up there, we combine them both together and we can see it's a loss of 8,900. All right, so losses are debits. So I'm going to debit the unrealized holding gain or loss account. And remember, this is dash net income because we're doing the fair value through net income method. All right, and that's 8,900. And then we have the fair value adjustment account, which we've talked about. When we did the debt investments, it's the same account. Okay, now we're just associating it with a different investment, and that gets a credit for 8,900 because we're reducing the investment balance. All right, now assume we sell all the company 2 stock for 265. Okay, so let's look back here. Company 2 stock, we can see we purchased for 273.4, and now we're going to sell it. All right, so when we sell it, and this is where we'll have a little bit of difference between the Kiso and the Spiceland book. When we sell it, we're going to have, if you think about, we're comparing our sales price, 265, to my carrying value, which is just the cost, 273.4. and that gives me my gain or my loss. We're selling it for less, so we're going to have an $8,400 loss. All right, so in the Spiceland book, they are going to recognize the unrealized gains and losses and adjust the fair value adjustment account up to this point. Okay, the Kiso book says let's not worry about that. Let's just record the sale, $265, and then the loss of $8,400, and we're going to take the equity investment dash company 2 off the books at its cost. All right, so they say let's not worry about that, and let's just wait to the next balance sheet date and we'll catch everything up. Okay, so it's just different ways of looking at it. So make sure, once again, this said the same thing in the debt investment portion. Make sure you obviously know which book you're going through and kind of see what your teacher expects as far as those journal entries concerned. All right, so let's keep going with this problem. All right, now assume we're going to purchase a new stock, company 3 stock. And so notice here we buy 20,000 shares at $14.25 a share plus a brokerage commission. All right, so that means we're buying 20,000 times $14.25, and that works out to be $285. But we also pay a commission. Now remember, the commission gets added in to the cost basis of the stock. So we're actually going to record this at $287,300. All right, so that's going to just be a debit to equity investment dash company 3 for $287,300, and a credit to cash, $287,300. All right, so I've been teaching this a number of years. I will, and always it seems like, even though I stress this in class and I want to stress it here, I will always get some students that will put equity investment on the books for $285 and then debit some sort of like finance expense or commission fee or some sort of debit for the 23, and that's just wrong. Remember, it gets added into the cost basis, so just make sure you make a mental note of that. If there is a commission, you're not going to make that same mistake that I've seen happen in the past. All right, so let's scroll down and adjust it at the end of year 2. So remember, once again, the Kiso book says let's just wait, and then we'll just catch everything up, true up these accounts at the end of the period on the balance sheet date. All right, so that's fine. All right, so let's kind of set up a little table here where we've got cost comparing to fair market value, and then that gives us our unrealized gain or loss. All right, so we have company 1 and company 3 now because company 2 is no more. All right, so we have $363,500, and the cost for this was the one we just bought, $287,300. All right, the fair market values are given as $374 and $294. All right, so we can determine the gain or loss for each. All right, so this one had a $10,500 gain. This one has a $6,700 gain. All right, so remember, we can combine those together because they're the same type of thing that we're working with here, and that's going to be $17,200 gain. All right, so if I set up my T count over here for the unrealized gain or loss, now remember, we are carrying forward the beginning balance, or the ending balance from last year is our beginning balance. All right, remember the number you calculate, it's a gain, so gains are credits in this account. All right, that's the ending balance. All right, so that means we need a credit of $26,100 to get us from the beginning balance of an $8,900 debit all the way to the credit of $17,200 for the ending balance. All right, so we're going to debit fair value adjustment for the $26,100, and we are going to credit the unrealized holding gain or loss dash net income for $26,100. All right, so you can see here that's the $26,100 is the adjusting entry that goes there. The debit to the fair value adjustment account increases our investments up to their current fair market value because they've both gone up. All right, so that means we should be all good going forward. All right, so just another thing to point out, do not forget this beginning balance. I mean, I've taught this class, and every year I'll stress this, and it does not matter. There will always be students that put $17,200 down here in this journal entry right here. And that's just wrong. 17.2 is the ending balance. You have to account for the beginning balance. So make sure you make a note of that. And when you're going back and reviewing this stuff before your test, that you keep, driving home that point. Okay. Your teacher may not give you a 2-year problem like this, just depending on how the time limit works on your exam. So they might just say, hey, the beginning balance in the account is X. Therefore, when you do that, put that beginning balance into your T account. Okay, so hopefully this is helping. This is our equity investments. Our next lesson, we're going to jump ahead and start looking at some more of the equity method. Right, so that's what's coming up next. So please share this with your friends. Hopefully this is a good example that will kind of help you review come study time. Thanks.